Everyone has an opinion on gold, but almost no one is looking at the data that actually matters. And that's what this video is about. We're going to look at how did the gold price perform based on data points that historically predicted the price quite well. Have a look at this here. At the bottom, so this x-axis shows the performance of the gold price in the last 37 weeks. On the y-axis, we see the gold performance in the following 37 weeks. So I'm making an analysis here on how did gold perform in the future relative to the past. Everybody says that past performance is no indication of future performance. But when we actually run the numbers, there is a connection. And that connection is different depending on what kind of time horizon we are looking at. Now this line here in orange, that's a regression line that best represents every data point on this chart. So every data point here is a combination of a 37-week window before and after. Why are we taking 37 weeks? On this case, 180 bars. So that's the number of trading days. That's because historically that was where the R squared was the highest. So this is where we've got the strongest connection between prior performance and future performance. Again, if you just look at the number of days. And that's why you're getting this chart. But there are analyses where the connection is even stronger. For example, over here. And we are going to talk about those as well. Now this is where we are currently at. So the past performance had been quite positive and the future performance should still be positive. This is our best prediction of what's going to happen in the next 37 weeks. So here is what that implies. We are currently at $4,711 per ounce of gold. Our past lock return was 37% or 38% in simple terms. Our forward lock return is 14% or 15% in simple terms. In other words, over the next 37 weeks, we should get to a price of $5,400, which annualized is still quite nice, 22%. We've got a positively sloped line on this chart. So this means that gold tends to trade in momentum in the short term. So when we had positive performance in the past, we tend to have positive performance in the future. Now this doesn't hold forever, of course. It only holds for the shorter time window. This is how that then looks as a price target. In January of next year, we will be around here and we are likely going to hit a level very close to the all-time high. Now there's no guarantee in this whatsoever, right? There's quite a bit of variation in this prediction. So the line does not perfectly represent the data set. It's just our best estimate. And that's why it's so important to distinguish between the short term and the longer term. In the short term, gold, but also many other assets, Bitcoin for example as well, tends to trade with momentum. But on the longer term, it might make sense to be contrarian. It might make sense, for example, to buy the bottom. When Bitcoin, for example, has crashed by 50, 60, 70%, it might make sense to do the exact opposite. But if Bitcoin is just starting to come down, it might make sense to take it seriously and not necessarily ride out the entire crash. So it's all about the time horizon. And for gold, it's the same. Just that for gold, the cycles tend to be much longer. When we don't take daily data, but weekly data instead, the best R squared is over here. It's at 845 weeks or close to 16 years. That's how long the gold cycles last. At the bottom, we've got the performance of gold over the last 16 years. And here on the left, on the y-axis, we've got the forward-looking return. And this here now represents the data points much better. And it shows us a negatively sloped line. In other words, it makes sense to buy gold when it performed really poorly over the last 16 years. And it might make sense to buy less of it if it performed very well in the last 16 years. And this is where we are right now. We are not at the extreme end of great performance, but we are definitely not super cheap either. We do expect positive returns though. How positive? Let's have a look at the numbers. By the middle of the year 2042, we should reach a gold price of $8,627, which annualized isn't really that much of a return. 3.8% per annum. That's then how that looks like on a chart. This is a very long-term chart. This starts at the beginning of the 1800s. The model also does not predict how we are getting there. If we continue quickly up and then crash to this price, if we crash right now and then go up to that price. But in general, the growth rate from here to that data point is not high at all. And given the analysis about early momentum, the more likely scenario is that we hit the old all-time high, and what's happening between that data point and the data point 16 years from now, that's open for discussion. So what does that mean? It means that any investment in gold should rather be seen as something very speculative. In the short term, it could very much outperform the rest of the market by roughly 20% per annum, but in the very long term, gold seems to already be rather expensive. At least historically, when it has rallied that much in the past, it continued to not rally as much in the future. In the end, gold is simply just a hedge against monetary debasement. And so I think it makes sense to compare the gold price to the monetary base. How is gold doing relative to USM2? I've shown this chart in the past on this channel. So this starts in 1959. Sometimes gold relative to the money supply is expensive. Sometimes it's cheap. Recently, it has rallied quite a bit. And this dotted line here, that's the average ratio of the gold price to the money supply. So just based on that, you can already say that there haven't been too many points in history where gold was much more expensive relative to the money supply. Only the end of the 1970s, the beginning of the 1980s, that's where gold was more expensive compared to today. So maybe gold has some way to give. But why don't we make the exact same analysis now for gold relative to the money supply? How did historical performance impact future performance? And then we get this chart over here. This time the optimal time window is 15 years in the past compared to 15 years in the future. That's where the correlation between past performance and future performance was the highest. And that's where we are currently, as in we did have positive performance in the last 15 years. So that's this over here. Thus, we should expect less performance going forward. How much less performance? Here is the answer. The gold price over the next 15 years on average should underperform monetary debasement by 3.4% per annum. Now the monetary base expands by roughly 6.7% per annum. So based on this model, the gold price should be doing less than that. It should still make US dollar gains, but it should not outperform the debasement. And so when we compound this over 15 years, that's how that looks like. We would hit bang on the equilibrium price over the next 15 years. I'm not saying that holding gold over the next 10-20 years is worse compared to holding fiat currency, but I'm also not saying that gold is a great investment right now. It has already rallied quite a bit. It is expensive. On a prior video on this channel, we compared the S&P 500 to the gold price. And with that comparison, gold did actually do better. So if you're only allowed to hold either stocks, so the broadly diversified S&P 500, or gold, it still might make sense to hold gold. But in the broader scheme of things, don't expect to gain a lot of purchasing power. Yes, the short term might still be promising. We still have positive momentum, but the long-term appreciation is likely going to be quite slow. Slow enough not to outperform monetary debasement. At least if history is any indication. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. Feel free to also check out the premium membership. This is where you get access to the backtesting tool. So all of the charts that you've seen in this video, you can run those similar backtests for other assets. You can run them for the S&P 500. You can run them for gold. You can run them for Bitcoin. There is a broad selection of assets on Bitcoin strategy analytics. And you can also look at ratios. For example, does it make sense to hold Google stock relative to, say, the NASDAQ 100? Should I buy Google directly, or am I okay with just holding the diversified index? There's all kinds of ways to backtest. There are also tutorial videos in premium how to use the tool, of course. Thanks for watching. See you next time on YouTube or see you on premium. Cheers.